afternoon. This is Chris Brecher with the Simpler Stocks free video for December 30th, 2015. As you see, it's about 4 minutes after the bell. Basically, today was one of those gap and goes that no matter how bad the market acted yesterday, all it needed was a little more oomph from the FANGL stocks, which is the Facebook, the Amazon, the Netflix, and the Google, and just the rest of the market took off. Basically, like yesterday when we had the SPX do this, where it gapped down yesterday in this area and then had a measuring gap to the downside. Then what happened is on a 5-minute today, if you look, it was the complete opposite. We rallied on the close yesterday by this amount, 2045 to 2055. Once you see the ESs that were gapping up, overnight, you could figure that wherever the SPX opened, it was going to go up 10 points from the low of today. So the low is about 2061, 10 points. Where's that get you? 2071. Where did we close? About 2078. We kept going. But the whole point is the minimum expectation was the amount of the previous move. And that's what I had actually posted on the Simpler Stocks premium side before the opening. Now, in this, what I was watching is you got another measuring gap in the Googles of the world. And I know it was hard to believe that these could go even higher. But let me just show you what I'm talking about in here. These have squeezes. The Amazons, the Facebooks, and the Googles. This is more like now turning in, instead of a top right here, it's turning into a, it's a consolidation formation. We could go up by at least, to 700. Now, the thing about this that I found interesting was, number one, look at this move yesterday in Google. Now, this is all about just the way I look at charts and measuring gaps. Measuring gap is the previous move. Let me zoom it out just in case I'm missing something in here. There you go. You have 770, the previous swing low, to 781, let's say, right in this area right here, is about 11 points. The low today was right here, about 786. What's 11 points? 798, 797, went right to there, and actually started weakening by the end of the day. But those are the type of measuring gaps you have to take advantage of, and a lot of times we talk on the Simpler Stocks premium side, whether it's in the forum of me chatting back and forth, or it's about us when I post charts before the opening. Those are the type of measuring gaps you can make a lot of money in. Now, I was showing actually some cheap stocks also, but let me go to Amazon, and let me show you the same kind of thing with a measuring gap. We don't always talk about just $700 stocks. We've gone to run the gamut from $10 stocks in the way up. So I don't want you to think you have to trade $600 stocks. This gives you just sort of a basis of the kind of stuff I'm looking at. As you can see in here, Amazon had this move and then this move. Facebook, same thing. Now, just so you know, when I see this, I then scroll down and look for stocks that maybe need to play catch up. But first things first, let me show you the overall market today. Show you the futures were up 23, the NASDAQ up 74, the Russell up 15, so it's starting to try to kick in. Transport's still only up 53, not much. But I think the big key going into 2016 is going to be the bonds down 208. I posted before the opening today about how precarious the bonds look. And let me show you what I'm talking about in here. The bond market on a 78-minute, I'm going to put that on the right. And this is what you need to watch in here, and this is what I warned about from just on how I try to say simple is better. The bond market right here rallied exactly to resistance. And once it did that, then it was on its way down. Look at this support level right in this area, 154. It blew right through that. If I'm right, it's going to go down at least that amount. So this is like a little rectangle. It's at least going to go 2 points, which puts it to 152. Let me show you why that's important. It's on the left here. You have 151.28. I've been putting the line in the sand there. And we have a squeeze starting to form in here. If it breaks 151.28, it could go way down at least to 148. And you put this on a weekly, and I know I've talked about this before on here, but all of a sudden then you have this weekly chart. You have a squeeze on there. If it breaks there, 149, but then it just does a squeeze release to the downside starting now. it could easily go and break this 144. What are the implications? Number one, if they go down quickly, and quickly like this, the velocity of the move is what seems to affect the market the most, the S&P. If we get a quick move down to, let's say, 148, right to this support right there, the first line, I think it's going to start affecting our market because one is that's about 0.4 of a percentage point in yields going up. And then people are going to start taking notice that there are other places to put their money other than the stock market. Obviously, that's been the theme for years, that yields are so low, nowhere to put your money. Well, that would be the start of where people are going to get a little worried about being in the S&P if the bonds are up an extra 0.5%. Second thing in here that it definitely starts taking notice is the yield curve. Is basically if short-term rates are doing this, short-term rates, as we know, went up a little because of the Fed. And at first, long-term rates did that. So basically that means the yield curve flattened. It got close to each other. If the long bonds start to turn back up like this, like they're doing now, and these flatten out, the yield curve will steepen. Why is that good for certain stocks? The banks. The banks have been languishing for years because the yield curve has basically been flat or sloping down just a bit. What that means for these kind of stocks is they don't make as much on their margins. Their margins are squeezed. If we see the bond market break down like that, even if I think it's bad overall for the stock market, it's pretty good for the banks. And I would think one of the themes in 2016 is for the big banks to start outperforming relative to the rest of the market. So you see this Goldman Sachs, obviously this year, it had that big sell-off in August. This panic down here came to test it around 170, a little bit under it. And as you see, we're at 183. We're not that far from there. If we get that steepening, I think you could get the stock back to at least 200, maybe 210. So that's something to keep in mind in there. What do I think going forward in this? You have to understand this is still the holiday week. And like I had mentioned before, that no matter how bad the market looked, the overall S&P, it probably wasn't going to go down this week or last week. And sure enough, it's held in like a champ, like you can see. I think you have to get through the end of the year. You're going to see the FANG stocks, the Facebooks and the Apples, probably marked up by fund managers at the end of the year because that behooves them when those are their biggest holdings. So I think you have to wait until Thursday, wait till everything sort of settles, and then see on starting next Monday of how the real market acts. So I hope this helps. Like we still have the trial, $7 for 30 days. Also, it looks like next week I'm going to start a live chat in the morning from like 7:30 to 9 in the morning, so Eastern time, so people can prepare for their trading day. Probably what I'll do is I'll have a live chat in that time where people can ask me questions back and forth, and from 8 to 8:30 I'll actually be on live talking and can respond verbally to your questions. And we might make that a little longer too if it the feedback I've gotten has been incredibly positive, so I might stay on longer than that. So everybody have a nice night, and I will be with you tomorrow. Take care.